Hey gang, we're now going to look at materiality. And of course, this is a professional judgment call. What we want to do is understand a little bit about how we handle materiality. And materiality is going to be different for different companies. To give you an example, if we're at General Electric, $10,000, that's lunch money to them. They round to $100,000 or $1 million. So obviously, that's not going to be as important. But if you look over here, we have an ordinary guy, $10,000. Now, to you and me, that's a lot of money. Maybe to Olinto, it ain't a lot of money. You know, he's filthy rich. But bottom line, the rest of us, that would be a material amount. So we have to understand the rules of materiality go with, it's your professional judgment. But there are certain terms you need to know. And of course, the examiners take fiendish delight in trying to test us on some of that information. So we want to go through materiality, performance materiality, and make sure that you're up on those. You saw them and probably read them in this chapter, but let's make sure you have them down before we try an exercise. So let's take a look. Materiality is very important to the audit, and it affects multiple areas. Materiality is used in planning and performing the audit, evaluating the effect of identified misstatements and the effect of uncorrected misstatements, and forming an audit opinion. You may recall we refer to that as SOAP, Summary of Adjustments Passed, SOAP. Let's first discuss overall materiality. Auditors take into account both quantitative and qualitative factors when determining that magic number of what is significant to the user of the financial statements. To make a preliminary assessment of overall materiality, the auditor usually applies a percentage to an appropriate benchmark. Typical benchmarks that auditors will apply that percentage to could be profit before taxes, revenue, net assets, total assets, earnings before interest, taxes, depreciation, and amortization, typically known as EBITDA. The benchmark used may vary from firm and by client. Many firms have specific guidelines for materiality. For example, firms' guidance may state to use the benchmark that is the lesser of profit before tax or revenue. This is a quantitative factor which number is smaller. On the exam, they will most likely inform you of the benchmark to use or provide you with information about the benchmark guidelines. You'll get practice with this in the practice exercise in this module. Once the benchmark is chosen, typically a percentage is allocated to that to determine the overall materiality. The percentage applied to the benchmark may also be a firm or by a client significant item. For example, one audit firm may use 5% of profits before taxes, and another may use 10% of profit before taxes. Or one audit firm may use 5% of revenues, while another uses 1% of revenues. The calculated overall materiality amount may be adjusted for qualitative factors as well. For example, the auditor may choose a different benchmark or percentage amount based on what the auditor thinks is important to investors. Investors may be mostly focused in on profit. Remember, materiality is subjective, not objective. That is why a percentage and benchmark may vary by firm and by client. On the exam, if they want you to calculate a materiality, they may give you a firm guideline and you will need to apply the applicable percentage similar to the example shown in the book or in the practice exercise in this module. Make sure to read carefully so that you can grab those points on the CPA exam. Let's summarize what we've learned about overall materiality. Now, first of all, this overall materiality is both for a non-issuer and issuer. It's used throughout the audit, including forming of your opinion. We have to first of all determine the benchmark, typically applying a benchmark percentage. All right, so once we have an overall materiality set, the auditor will then typically calculate a performance materiality. Now that performance materiality will be different. For example, one firm may use 70% of overall materiality and another may use 60%. Performance materiality is used for the purpose of assessing risk of a material misstatement and planning and performing audit procedures at the account or disclosure level. The PCAOB refers to performance materiality as tolerable misstatement. Okay, so tolerable misstatement is the terminology we use when we're dealing with an issuer. We use the term performance materiality when we're dealing with a non-issuer. Because percentages may vary, make sure to read carefully on the exam for what percentage they want you to use. Let's summarize this and make sure to make the performance materiality box smaller, since the amount is smaller than the overall amount. And as you can see, that gray box is smaller than the blue box. And what are we doing? We use for the purpose of assessing risk of material misstatement and planning and performing the audit procedures at the account or disclosure level, typically applying a percentage to the overall materiality, such as 70%. Now, I want to clarify a term that you will use in Unit 4. The AICPA uses the term tolerable misstatement to mean the application of performance materiality to the sample. Typically, performance materiality and tolerable misstatement are the same amount. However, tolerable misstatement may be a lower amount. This may occur when the auditor selects a subset of the population for sample. So let's summarize this. By using this box. Notice the tolerable misstatement is even a little bit smaller. So it's used for sampling, typically applying a percentage to the overall materiality. For non-issuers, this amount is usually the same as the performance materiality. So it's pretty darn close. It might even be identical. Next, auditors may also use a smaller materiality amount than the overall financial statements as a whole for particular classes of transactions, account balances, or disclosures. For example, the history of material misstatement in relation to a particular balance or class transaction may require a smaller materiality amount. Also, higher risk items may require a lower materiality amount. So let's summarize this and make specific materiality box is a smaller one. You'll notice in this particular case, and notice we use it for specific areas, typically for transactions, account balances, and disclosures, and to determine appropriate amounts. Remember, often firm guidance provides insight into how to calculate materiality. In other words, the quantified amount. But they also often add that the auditor should take into account qualitative factors. So this is all part of the process that needs to be reviewed. So gang, what we have is the overall materiality, which is typically a percentage of assets, a percentage of income, a percentage of gross revenue. And then we take that, and when we're going to look at performance materiality of looking at something, we usually say can't be more than 60 or 70% of the overall materiality level. Note, we call it performance materiality with non-issuers. We call it tolerable misstatement for issuers. And then we come down and we can take a look a little bit more at specific materialities, could even be a little bit smaller for certain types of transactions, account balances, disclosures. So be aware, these are the terms we need to know when we try the next exercise.